Okay, for this video, I want to go over the IRS Form 8995 Qualified Business Income Deduction, and specifically I want to look at how we account for qualified REIT dividends. So REITs are real estate investment trusts, and they can be publicly traded or non-publicly traded, but these have a unique carve out in the code where they are eligible for the QBI deduction, right? There are certain portions of the dividend that might be eligible. So we want to look at the REIT dividends and how it interacts with other kind of qualified businesses. So I've got an 8995 here that's part of a full return for our taxpayer, John Q. Taxpayer. I have a sample 1099 DIV for dividends and distributions. And so what we'll be focusing on here is the box 5 amount for section 199A dividends. And then lastly, I do have one slide here covering some background on QBI and then the interaction between REITs and the other QBI or rather qualified businesses that might be reported on the 8995. So when we talk about the qualified business income deduction, it's really two pieces, right? So the first one is the kind of general QBI component that we're most familiar with, and this is the deduction from income flowing through from domestic businesses. So partnerships, S corporations, sole proprietorships, these types of businesses, if they're qualified businesses, you might be eligible to take the QBI deduction on those amounts. The second piece are REITs, so REIT dividends, and then publicly traded partnership or PTP income. So the reason these are separately stated is because they cannot be aggregated or netted against the other qualified business income. And so that's why we see them separately stated here on the form. So when we look at the form, the qualified businesses that you have from sole proprietorships that are coming from Schedule C or K1s or in partnerships or S corps, those amounts are listed here in Section 1, and then we compute the component amount 2 through 4 for the amounts that we're seeing in Section 1. But then lines 6 through 8, we see the separately stated REIT and PTP amounts. Right? So when we talk about our overall qualified business income deduction, we have to look at these separately, and then when we compute the component, then they can be aggregated and then ultimately subject to the entire taxable income limitation, right? That 20% income limitation on your taxable income. So what do we talk about with REIT dividends? What's important is we don't have a lot of the same limitations, right? So when we look at REIT dividends or PTP income, the deduction is 20% of those eligible amounts, but we don't have these issues with W-2 or U-Buy qualified property limitations, right? So if you're a high-income taxpayer and you have qualified business income and you have all these phase-outs because you have to be mindful of the W-2 or U-Buy amounts, if you have income from REITs or PTPs, you don't have to worry about that, right? So that's kind of a nice thing. Now, what about the interaction between all of this? Well, again, the REIT dividends, they have to be separately stated, right, as we saw in the 8995, and we're not able to net these amounts together, right? So we can combine PTP and REIT amounts, that's okay, but we can't net them against other income or loss that we would otherwise have from our other qualified businesses. So the term qualified REIT dividends means any dividend from a real estate investment trust received during the year that is not capital gain dividend and it's not qualified dividend income. Now, the nice thing is if you invest in REITs through a broker, the custodian, they're going to get this information from the REIT and pass it on to you directly. So you don't have to do as much work, I'll put it that way, right? So you'll get something that looks like this that might have the ordinary qualified dividend amounts, some capital gain distributions, and they should separately state the amount of eligible Section 199A dividend amounts, right? And so there's that $730 that's going to apply to John's taxes. Now let's look at the fact pattern itself, and then we'll go back to the return. So we have John Taxpayer here. He's operates a consulting business through a single member LLC. So he reports all of his income and expenses on the Schedule C, and he has a net loss for the year, so $1,490. So if we look at his tax return. We jump to the Schedule C here. So here's the Schedule C. We can see he's reported his income and his expenses, and he's got a net loss there. Now, the reason why I want to highlight this is, again, this netting issue, right? So even though he's got negative amounts of qualified business income from this activity, he's not going to be able to, or not, he should not be offsetting the qualified REIT dividends with these amounts, right? The $14.90 from this activity, because it's an overall net loss in this category, that's carried forward to next year. So we can see here on line 16 that the $14.90 in losses from his Schedule C are being carried forward to the subsequent tax year, but he will nevertheless still get a QBI deduction for the REIT amounts, okay? All right, so he's done that, and then he also has this publicly traded REIT, pays quarterly dividends. So again, he gets this 1099 div, and he sees that the box 5 amount is $730. So pretty straightforward, right? So he's got his $89.95. He's already taken care of the Schedule C issue. And then the amount of qualified REIT dividends that he received is $730. He has no carryover from the prior period, so the total amount, or the net amount of qualified REIT and PTP income for the period is going to be $730. And then the component amount, multiply line 8 by 20%. So the $146 deduction is what he's going to be able to use to reduce his taxes. So the $146 is simply reported up here on page 1 of the 1040. So we can see on line 13, qualified business income deduction from either the $89.95 or $89.95A, and there's his $146 deduction. All right. Now, what's also really important to remember here is to accurately be tracking these carry forwards. Right. So this year we're assuming that he didn't have any prior year activity or carryover. So on line 3 we have no carryover from those qualified business income amounts, and then line 7 he doesn't have any carryovers from REITs or PTPs, but he does have this loss carryover for his Schedule C, which he needs to be picking up next year. Very, very important, because Section 199A carry forwards for these losses, they are required, right? You have to do it, and the unfortunate thing is these are some of those carry forwards that are not to your benefit, right? So the carryovers of the losses have to be used. The carry forward indefinitely, so they never expire. They have to be rolled forward every single year until they're absorbed by positive qualified business income. So it's unlike a lot of other carryovers that we see, like foreign tax credits, NOLs, capital loss carryovers. Those are kind of good ones that we're happy to move forward every year. But with 199A, negative amounts, not so much. But nevertheless, again, it's still required. So that covers it for this video. I hope that was helpful. If you have any questions, feel free to leave a comment below. Happy to answer any questions I can. And I look forward to seeing you again on the next video. Thank you.